Welcome to part 2 of the latest podcast from the Gold Chronicles with Jim Rickards, presented by Physical Gold Fund.
Well, let's stay with the dollar part of this story for a moment and look at how China plays into this. I've read that China has been selling off a record volume of US Treasuries recently, and that plays into a rather popular narrative that at some moment China is it's almost waiting to pounce, is going to offload huge volumes of its US debt, basically in a play to wreck the dollar and the US economy. Could you give us your view of this theory?
Well, some of it's theory, some of it's facts. Let's start with the facts. That's always a good place to start. China is, in fact, selling treasuries, and China is, reducing its overholdings of treasuries. And there's been an enormous drain of reserves from China. They've lost over $400 billion of reserves in the past 3 months, part of which was used to prop up their stock market, part of which was used to defend their currency, at least until they broke the peg in early August, part of which is still being used to defend their currency now because they've got a new peg at a lower level, and some of which is going because there's capital flight coming out of China, and Chinese oligarchs and princelings and politically connected people are saying, I want some dollars, I want to get out of here, and buy a nice condo in Vancouver, Melbourne, or Sydney, or Istanbul, or London, or all these places around the world. So what's interesting about that is that, when you have $4 trillion of reserves, which is where China started this process, it looks like an impregnable castle. It's like, wow, that's $4 trillion, that's a lot of money. Well, that's fine if the dynamic is going your way, but when the dynamic reverses and you start to lose reserves, you start to drain your reserves because you're pursuing some policy, it's amazing how quickly they can disappear. So, of course, the emerging markets found this out the hard way in 1997. Mexico found it out in 1994. Places even today, Malaysia's reserves are draining away. So it's kind of a scary thing to watch. It's like watching the gas in your gas tank go down. You may still have 3/4 of a tank, but if you keep going, and you can't find a gas station, you're going to hit empty. So China is losing reserves. They're losing them quickly. They are selling treasuries to basically pay for that outflow of dollars. So why aren't U.S. interest rates skyrocketing? Why hasn't the U.S. Treasury market collapsed? Why aren't all these horrendous things happening that so many people predicted when China started selling treasuries? Well, the answer is there are plenty of buyers. In other words, if somebody's selling, somebody's buying. And so to me, the interesting question is not that China's selling, which they are. By the way, this is not some kind of coordinated assault on the U.S. dollar. It's not some nefarious plot by the Chinese to dump treasuries and sink our markets. Far from it. China's playing defense. They're not on offense. They're playing defense, trying to either manipulate their currency or deal with the demands for capital flight or prop up their stock market, as the case may be. So to me, the interesting question is, who are the buyers? Well, there are plenty of them. First of all, people are getting out of other markets. It's almost like, Malaysian forces the Malaysian company forces Malaysian central bank to sell treasuries to give them dollars, and then that individual company takes the dollars and buys the treasuries. It's like, this is something that Walter Wriston explained to me 35 years ago. I was a young senior officer at Citibank, kind of 27, 28 years old, sitting at lunch across from our chairman and CEO, Walter Wriston, one of the most famous bankers of the 20th century. And I said, I just seen this movie Rollover, old Jane Fonda, Chris Christopherson movie from the 1980s, oldie but goodie. But the plot of the movie at the time was the Arabs were secretly pulling all their money out of U.S. banks, buying gold, and that was going to lead to the collapse of the banking system and the dollar. And I'd seen the movie, and so I said, Mr. Chairman, what do you think about the possibility of the Arabs pulling all their money out and buying gold? Wouldn't that be the end of our banking system? He looked at me kind of benignly. He said, well, what you have to understand is that the global financial system is a closed circuit. So the Arabs certainly could pull their money out and buy gold, but the guy who sold them the gold is going to get the money, and that guy's going to put it back in the bank, and that bank's going to lend it to us. In other words, as long as the interbank lending system functions, the money doesn't go anywhere. It's a closed circuit. So we're seeing something similar in treasuries. It is true that the Chinese are selling, but there are plenty of buyers, and some of the buyers may be wealthy Chinese who are getting their money out in the first place. And so they just take the dollars from the central bank, come to Vancouver, buy some treasury bills, and you're back where you started. So, and at the end of the day, there is one buyer of last resort, which are the big U.S. banks. They will be forced to buy the treasuries. This goes under the heading of financial repression. I think a lot of people have heard that term, but this is financial repression in real life. It's an economic analysis. It's been articulated by Carmen Reinhart. Before that, even in the late 1990s, if you look at Reinhardt's seminal paper, she credits Alberto Giovannini, a former partner of mine at Long-Term Capital, very well-known Italian economist who wrote about this in the 90s. But the idea is that at the end of the day, governments can make banks do whatever they want. In 2008, all the banks got bailed out. I think it would happen in 2008 or so. Early 2009, these bankers stick their head out of the foxhole. The shooting has stopped. There's smoke everywhere, damage, carnage everywhere. And they're like, hey, I survived. My bank is still here. I got bailed out by the government. I still have my phony baloney job. I still have my, $1 million plus bonuses. This is great. I can get back to business and pay myself lots of money. Well, they miss one thing. They were bailed out. They did keep their jobs. They did keep their bonuses. But what they miss is that they're now wards of the U.S. government. They're working for the U.S. government. If the Fed makes them buy bonds, they will buy bonds, and the Fed can just say, if you don't, we'll shut you down. So I'm not too worried about Chinese selling because there are plenty of buyers out there, and if all else fails, the banks will be forced buyers. And so this will equilibrate the market, and I don't think it's that cataclysmic.
Well, thank you. Shifting the focus for a moment, you recently had an extensive conversation with a very interesting individual. I'm thinking about General Michael Hayden, whom you dubbed as America's top spy, with good reason. He's the only person to have headed up both the Central Intelligence Agency and the National Security Agency here in the US. The focus of your conversation, as I understand it, was financial warfare, a recurring theme in our conversations, and I'm curious to know what you gleaned from this exchange with the general.
Yeah, it was a very interesting conversation, and Mike Hayden is my favorite spy. He's a really, really nice guy, brilliant, 4-star Air Force general, had led multiple intelligence agencies, including Air Force intelligence, before he became head of the NSA, National Security Agency, and finally director of the CIA. He's a nice guy. He's kind of bald and wears glasses and a little schlumpy. He looks about as much like James Bond as Elmer Fudd, but that's the real world. I mean, not all spies are running around in tuxedos playing a Casino Royale. Some of the best spies are actually people you wouldn't even notice in a crowd, and that can actually be very effective. General Hayden told me stories about when he was in Bulgaria. He used to just buy a ticket on a train to the end of the line. He'd ride the train all day and then get to the end of the line, buy a ticket back, and ride the train back. But of course, in places like Bulgaria, where the road system is not that well developed, a lot of stuff moves by rail, including tanks and military hardware and troop trains, etc. And just by being a passenger on a train and going from one end of the country to the other in the course of the day, he picked up enormous intelligence that he could then debrief to his associates. So that's sort of old school spying and very effective. But what we talked about was cyber financial threats to national security, cyber financial warfare. That's a bit of a specialty of mine. Of course, he was fully conversant with that. And the NSA is really in charge of what we call SIGINT. Any INT is just as short for intelligence. So SIGINT is short for signals intelligence. It's basically intercepting radio transmissions, telephonic transmissions, internet, any kind of telecommunications. There's what we call human intelligence. That's the old cloak and dagger spy type of stuff. But so he was very conversant with this. He said categorically, he called cyber warfare the PGMs of the 21st century. For those who don't know, PGM is a precision guided munition. So that's like a cruise missile, Tomahawk cruise missile, or something from a Predator drone. So precision guided munitions. He said cyber financial attacks are the PGMs of the 21st century. He didn't suggest that would be the main battle space today, but said over the next ridgeline, or maybe the one after that, it's how wars would be fought. And I disagreed a little bit. I said generally, I think it's here now. I think there's and of course he would know as well as I, but it's a pretty active field right now. But there is this recognition in the intelligence community, in the national security community, that cyber financial warfare is as much a threat as chemical, biological, radiological weapons, or certainly conventional kinetic weapons of the kind we're all familiar with. That has interesting implications for investors, because we all know the traditional arguments in favor of gold, but there's now a new 21st century argument in favor of gold, which is that it's non-digital. You can't wipe it out. You can't hack it. We know we're talking physical gold. Now, if you've got paper gold on COMEX or something, ETF, then that's just a digital asset, and that can be hacked or erased. But if you've got a lot of your wealth in a brokerage account at Charles Schwab or Merrill Lynch, or Goldman Sachs for that matter, I know people who say, well, I'm really wealthy, I've got all these stocks and bonds, and I go, really, where are they? And they'll show you an account statement. Well, the account statement, maybe they get one in the mail, but that's probably online too. And I go, well, that's interesting. Look at all those nice assets there in the account statement. You realize they can all be wiped out and erased in a heartbeat. So what do you really have? What you have is a bunch of digital representations of potential wealth in a rule of law society. But what if that's erased? What if it's hacked? What if the rule of law breaks down? What if governments freeze assets, etc.? Physical gold is the one thing that's immune from all that. So it's not a reason to have 100% gold, but it is a reason to have 10% gold, in my view, because it gives you some protection against that, in addition to all the traditional reasons for gold. So, but it is interesting to meet with and talk to someone as experienced and plugged in and prominent as General Hayden, who is in complete accord with myself and others that financial warfare is the battle space of the 21st century.
Jim, lastly, before we turn back to Alex here, there's been a consistent vocal minority, of which you're a part, predicting an imminent financial crisis. You're not saying when it'll happen, but you've said again and again, we're in for a financial crisis even beyond the scale of 2008. And I sometimes hear people speaking rather dismissively of the sort of doomsday crowd. So I found it interesting when you pointed out recently that some of the voices this so-called doomsday crowd includes the Bank for International Settlements and the IMF and the G20. I wonder if you could elaborate on that a little bit.
Sure. First of all, you're right, John. I do see a catastrophic collapse of the international monetary system. I don't think it's inevitable. I don't think it has to happen. I just think it's very likely that it will happen, because I don't see any signs that the remedial steps or the preventive steps are being taken. Now, I could give you 4 or 5 things that could be done tomorrow that would prevent it from happening, including breaking up the banks, banning derivatives, banning high-frequency trading. None of these things really serve any particular purpose other than to enrich the individuals who are behind them. They don't do society any good, but and getting rid of them would lead to a more stable system that would still serve everyday investors in terms of market liquidity and being able to trade stocks in secondary markets, et cetera, which was the original purpose of a stock market. So I think there are things that could be done to prevent it, but then as an analyst you have to say, well, okay, is anyone doing those things? Is anyone taking those steps? And the answer is no. Therefore, I'm back to the other branch of the tree, which is that, okay, if we don't have systemic reform, we will have systemic collapse. And so that's very easy to see. When I say easy, I mean there's analysis and science and recursive functions and other equations behind it, but it's a pretty straightforward analysis. Timing, you cannot call it to the day, the month, or the year. I think over a 5-year horizon, it's more likely than not. Over a 3-year horizon, still more likely than not. But that's not the same as saying, it'll be next month or next week, although it could be. So that's the interesting thing about it. When I say it's more likely than not in 3 years, I don't rule out the fact that it could happen tomorrow. I'm not predicting tomorrow. I'm just saying that that's part of the analysis, that's part of where you get to. Now, having said that, 2 things. I do not consider myself a doom and gloomer. I do not consider myself part of the doomsday crowd. When this catastrophic collapse that I'm describing happens, it will not be the end of the world. We will not all be living in caves, eating canned goods, with our trigger fingers on machine guns. I mean, I don't think that's true at all. I think we'll still be in our houses, we'll still wake up, and life will go on, but it'll be a different world financially. We'll see extreme responses. We'll see, emergency summit conference of leaders, not unlike the November 2008 G20 conference in Washington that George Bush and Nicolas Sarkozy put together on fairly short notice. So, and we'll see, a reformation of the international monetary system, maybe in a venue, something like Bretton Woods. I would like to see that happen today, before the collapse happens, in a kind of rational, forward-leaning way. And actually, I mentioned earlier, I spoke to Ben Bernanke recently, of course, former chairman of the Federal Reserve. I also had a conversation with John Lipsky. John is a very interesting individual, great guy. He is the only American ever to head the IMF. And people who are familiar with the IMF say, wait a second, the IMF job is reserved for non-Americans by tradition. It's not a law or anything, but when Bretton Woods was set up, it was sort of a handshake deal that the head of the World Bank would always be an American, and the head of the IMF would always be non-American. That's been true for all these years, and yet John Lipsky, an American, was head of the IMF, but it was brief, only a few months. It was after our friend Dominique Strauss-Kahn was arrested on an airplane in JFK and faced some fairly scandalous charges. That, see, normally the IMF succession is very orderly. Well, that was a little disorderly, so DSK had to resign. John was the number 2 guy, deputy managing director, so he became acting head until they could figure out Christine Lagarde, who came in a few months later. But he was head of the IMF for a short period of time. So what's interesting is, having spoken to former chairman of the Fed and former head of the IMF, one conversation in Korea, one in Washington, just a few weeks apart, they both used the same word to describe the international monetary system. They both used the word incoherent. And I don't think that they rehearsed that for my benefit at all. I think it's just the word that comes to mind among the power elites as to what's going on. So that's indicative of the state of affairs, and points to what you were saying, John, which is, if you said to me, hey, Jim, who really runs the world of finance? Like, what are the most powerful establishment institutions in the world? You'd have the Fed on that list in terms of elites. You look at the Bilderberg Conference. And I've spoken to Bilderbergers about this, but the 3 most powerful multilateral institutions would be the Bank for International Settlements in Basel, Switzerland, the BIS, the International Monetary Fund based in Washington, the IMF, and the Group of 20, or G20, which is a kind of a floating crap game of developed economies and BRICS and some emerging markets, and they meet all over the world on a rotating basis. All 3 of them have issued very dire warnings. It's not just, oh, gee, we better slow down, we better do this. It's like, no, we are looking at a highly unstable financial situation. They've practically threatened Janet Yellen. I mean, Christine Lagarde gave her multiple warnings. The G20, they just met, G20 finance ministers just met in Turkey and issued a warning. These are very blunt warnings. So when I see the power elite warning about global financial instability and the potential for collapse, not only does it confirm my own analysis, but it says to me, they're trying to wash their hands of this. They're saying, we told you. When it happens, they'll be able to say, hey, don't blame us. We told you this was coming. So any investor who's not prepared, I hate to blame the victim, and I do sympathize with people who lose a large percentage of their net worth because they were all in the stock market. Didn't have some gold, but when it happens, as much as one might sympathize, there's really no one to blame because you have been warned.
Well, thanks, Jim. And now, if we may overrun a little bit, here's Alex Stanzik.
Sure.
With questions from our listeners.
Okay, great. Thanks, John. So we've got about 5 minutes left of our traditional time slot, but Jim's graciously agreed to give us a little bit longer. I want to thank all of our listeners and the people who've sent in questions. We get questions typically over Twitter. We get some by email when we schedule these webinars. We also get some coming in live while we're doing the webinar. Just some quick guidance about these kinds of questions. If people would refrain from asking questions about having to do with legal advice, tax advice, possibly some trading advice, but also questions that we've answered a lot of questions that tend to come up over and over again in these webinars. We have a large archive of webinars available. We've been doing this with Jim for almost 2 years now, I think. And if you want to go to the Physical Gold Fund website, there's a huge archive there which in those various different webinars answers a ton of these. So from there, we're going to move on and go to the first question. This is a Twitter-based question, and this is coming from at AWYEE707. And his question is, how can the Fed cheapen the dollar without raising the price of gold?
They probably can't. I think if they cheapen the dollar, it will raise the price of gold because, as I mentioned earlier, the dollar price of gold is just the reciprocal of the dollar. So strong dollar is lower price of gold, cheap dollar is higher price of gold. Now, it's not as simple as that. It's not a perfect correlation, but it's a strong correlation. The other driver, which we also talked about earlier, are real interest rates. If somehow you had a cheap dollar in a world of high real interest rates, that's kind of a mixed bag. I mean, you've got one force pulling gold down, which would be high real interest rates, and another force pushing gold up, which would be a cheaper dollar. But that's just back to this inflation, deflation, tug of war that I started talking about in my first book, Currency Wars, in 2011, and hasn't gone away. That dynamic is still in place. But bottom line is, is you have to say, well, how do you get to a cheap dollar? You can't just wave a wand and say cheap dollar. You actually have to do something, and that would mean probably a stronger euro, a stronger yen. A cheaper dollar would start to import inflation into the United States in the form of higher import prices. That, in theory, would feed through the supply chain and get a little bit of inflation going, and that would actually, remember the equation, nominal rates minus inflation equals equal real rates. Well, with higher inflation, the real rate's going to come down. That's good for gold. So I think if the Fed does try to engineer that, that's very bullish for gold.
Okay, very good. Next question is coming from Juha M. And the question is there some kind of big problems with helicopter money? And I think what he or she is saying by this is money that's given, I guess, directly to people. Why haven't the central banks use it if they really want inflation?
The reason they haven't, and they may yet, this is the president of the Federal Reserve Bank of Minneapolis, Kojo Lakota, a couple of days ago actually gave an interesting speech where he talked about this. But here's the problem. To do helicopter money, you need cooperation between the Congress and the White House and the Treasury and the Federal Reserve. They all have to be involved because, I mean, the notion is you print up a bunch of dollar bills, rent some helicopters, fly around, push them out, the helicopters, and everyone scoops them up. That's an interesting metaphor, but that's not actually how it works. The way you do it is the Congress would vote larger deficits. No, it's to spend money, just spend money. And you say, well, where would that money come from? Well, the Treasury would borrow it. And then you say, well, how would the Treasury finance the borrowings? Well, the answer is the Fed would print money and buy the bonds. So the handoff goes from the Congress in terms of voting the spending, then the President has to sign the bill, then the Treasury has to finance the deficit, and then the Fed has to print the money and buy the bonds. So they all have to work together. Now, what this does, at the end of the day, the Fed's still printing money, but when they print money in QE, what they do, they buy bonds, they buy existing bonds, secondary market bonds from the banks. And when they buy the bonds, they credit the bank's accounts with dollars that come out of thin air. So that's how they print money to buy bonds in QE, but where does the money go? Well, it goes to the banks. Well, the problem is it's just been sitting there. The banks then take the money and redeposit it with the Fed in the form of excess reserves, and then the money just sits there. So banks don't lend it, people don't want to borrow it, nobody's spending it, velocity's down. So you can print all the money you want, but if it's not getting lent and spent and there's no velocity, then that doesn't do anything for inflation or nominal GDP. The difference with helicopter money is you bypass the banks, you disintermediate the banking system and give the money right to people. When I say people, if the Congress votes an infrastructure project, that money is going to go to construction workers and the owners of construction companies. Or if the Congress votes some new benefit, then that money is going to go right to the people who participate in that particular welfare or benefit program. So those are the people who get the money, but the point is you're not relying on the banking system. But having said that, it's theoretically possible, and if they get desperate enough, they'll try to make it happen. But you might not see that till 2017 because you're going to have probably have the same party, Democrat or Republican, running the White House and the Congress to make that happen because these guys are barely, Republicans and Democrats are barely talking to each other, so it's hard to see how they could actually pull this off. But 2016 is an election year, and there's nothing Congress doesn't like about more spending in an election year, so maybe it'll happen after all. But that's how it works, and that's what you have to watch for.
And this entire topic kind of comes back around to the whole idea of the Fed being able to push the economy in the first place, right? So as you said a little while ago, the Fed follows the economy, it doesn't lead the economy. And looking at what the Fed's tried to do ever since 2008 and even before, it doesn't seem like anything that they've done really has had any kind of effect. So what we're probably looking at here, if I remember correctly from things you've said before, is that in order to get real inflation, we're going to have some kind of sentiment or shift in the psychology before something like that happens.
That's right, and it's not easy to do. It took the worst recession and the worst financial panic since the Great Depression to shift people from spending to not spending. What's it going to take to get them to shift back again into spending? And the answer is I don't see that happening anytime soon.
Okay, so we've got one other question here, if we can do this one. This one's coming in from Steve M. And his question is, with Europe continuing to slow, do you see Draghi increasing Euro QE into the end of the year?
Well, Draghi is my favorite central banker. He's the only one who really understands central banking as far as I can tell. And when I say that, he understands that central bankers actually have very little power, so you have to talk a good game. And if you talk a good game and put up a brave face, people actually, kind of believe you. So Draghi, go back to June of 2012, during one of the periodic sovereign debt crises, because Greece has been in continual crisis from 2010 to 2015, but some periods are worse than others, and summer of 2012 was one of those acute periods. And Draghi said, I will do whatever it takes to defend the euro, and believe me, it will be enough. And that phrase, whatever it takes, I thought was a little bit of bravado, but he meant it. And so I think Draghi will do whatever it takes. Now, the euro seems to have stabilized. As I've said, I don't see any real chance that the euro is going to fall apart. I got pretty much laughed at for years about that, but it's working out that way. Greece is still, you go to Athens tomorrow, you're going to spend euros. They're not out of the euro, and nor will they be. But Europe is doing okay for the time being, but remember, the reason they're doing okay is because of the currency wars. The euro got cheap. It went from $1.60 to $1.40 to $1.20 in February of 2015. It was $1.05. At that time, everyone said it's going to par, and I said, no, this is a bottom. And it's come back. It's up a little bit. I see it getting stronger next year, but the euro is held together. But that's what has given Europe a lift. Actually, Europe's kind of doing okay. The Irish economy is doing very well. The Spanish economy is doing very well. Sure, there are pockets like Greece and Eastern Europe, and even France for that matter, that are not doing that well. Germany is probably going to slow down a little bit because of the slowdown in China, because they have such a large trading relationship with China. So it's a mixed bag, but on the whole, Europe is a little bit of a bright spot. But that's because the euro got cheap. Now, the interesting question is, the U.S. engineered a weaker euro and a stronger dollar to help Europe in the belief that the U.S. economy was strong enough to bear a strong currency. But that was a blunder. It turns out that the U.S. economy was not strong enough to bear a strong currency. We got the strong currency, but we're flirting with the recession. So the interesting question in my mind is, at what point does the U.S. wake up and say, you know what, the strong dollar thing's not working for us. We need a weaker dollar, as we had in 2011, to keep the game going. And hey, Europe, you know what that means. We get a weaker dollar, you get a stronger euro. And if that happens, Draghi may actually do more QE, just to, or maybe even deeper negative interest rates, just to give Europe a little bit of a lifeline. So the problem with currency wars, it's not only are they not a positive-sum game, they're not even a zero-sum game. Cross rates are a zero-sum game, but currency wars are probably a negative-sum game because of the uncertainty that gets introduced into the global capital flows and the global trading system. So again, I think for now, Europe's a bright spot. I think there are a couple of places that are worth looking at, but and I don't think that's going to change in the near term, because I think the Fed will continue to blunder in their forecasting ability and think that the U.S. economy is stronger than it actually is, and they can still talk tough and talk about the October surprise and keep a strong dollar, and somehow that's all going to work. But by late this year, early next year, I think even the Fed will see reality, and at that point, you may see the beginning of a more of a weak dollar policy and a stronger euro, and then that's just going to, Draghi's just going to have to go along with that. But because at the end of the day, the Fed has Europe under its sway because of the importance of the dollar-euro swap lines between the central banks to prop up the European banking system. So it's all connected, interesting ways that it will play out.
Okay, and that sounds like possibly the beginning of the next round of the next salvo in the currency wars, which may continue until we see that psychology shift.
Right.
So thanks, Jim.
Yeah. Thank you, Alex.
And with that, I guess we're going to hand it over to John.
Thank you, Alex. And let me just briefly remind our listeners, you can follow Alex Stanzik on Twitter. Just go to Twitter and type in Alex, then STANCZ or ZYK. And great insights and very valuable links to follow there. And thank you, Jim Rickards. It's always a pleasure and an education having you with us.
Thanks, John.
Most of all, thank you to our listeners for spending time with us today. And of course, you can also follow Jim on Twitter. His handle is @JamesG.Rickards. So goodbye for now, and we look forward to joining you again soon. Bye-bye. Joining you again soon. Bye-bye. Joining you again soon.
You have been listening to The Gold Chronicles with Jim Rickards, presented by Physical Gold Fund. Recordings can be found at physicalgoldfund.com/podcasts. You can register there for news of upcoming interviews with Jim Rickards and other world-class thinkers.